What do sentiment readings and ETF industry sector performance tell us about the stock market's mood? And how can you position yourself for gains? I'm going to tell you right after this. I'm Ron DeLegge. Welcome to ETFguide TV. Thank you for joining me. I'm going to share with you some charts on today's program. Performance for S&P 500 industry sector ETFs. We're going to examine what it's telling us about the stock market's mood or sentiment. Just a quick reminder, be sure to subscribe to ETFguide TV. Tell us how you've been enjoying the program. Hit the like button if you like what you're watching, and post some thoughts below. You know, I always love to hear from you. I also want to alert you about an ebook that I created titled 60 Smart Ways to Retire Better. And that book covers key topics like maximizing Social Security, how to avoid distribution pitfalls, and if you're near or already at retirement, I know you're going to really enjoy the book, so be sure to download it. I've provided the link below in the description section, so be sure to get that. Now, one of my favorite investing greats, Gerald Loeb, once quipped that the most important single factor in shaping security markets is public psychology. He didn't say dividend yields or PE ratios or market volatility. It's psychology. And so having survived the 1929 market crash, I think it's safe to say that Loeb knew a thing or two about market mindsets and how people act and just the market's mood overall. And as the first quarter of 2021 comes to its conclusion, I have to ask a related question to Loeb's main point, which is, how is the stock market's mood right now? And what does it tell us for the current future and foreseeable future? So let's examine this question from a few different angles, starting with sentiment readings. And so let's begin by taking a look at the CNN Fear and Greed Index, which I think is a great reference point. You can see here it's currently at 60, which is modestly in greedy territory. It's up slightly from a month ago, but not what I would consider an overly extremely exaggerated reading at this current moment. The Fear and Greed Index, I think, is helpful also because it combines 7 different factors, including safe haven demand, market volatility, and several other factors into one final aggregated output. And it's that output, I think, that gives us an excellent snapshot of the stock market's headspace at any given moment. So right now we're at 60, and like I said, a month ago we were just under that. So we're close to neutral when you look at it from that angle. Let's take a look now at the industry sector performance of a couple of defensive sectors. I always like to see how those defensive sectors are performing relative to the rest of the market. So we look to consumer staples, ticker symbol XLP, and utilities, XLU, which have modest year-to-date declines between about 0.5% to 1.5% respectively. Both utilities and consumer staples continue to lag. And look at that chart since late February. Even though they've been lagging year-to-date, they've made a pretty nice run since late February, and we'll see if they can continue to build upon that. In our next chart, before we do that, I forgot to mention XLRE is also in that particular chart. You'll notice the real estate sector has been on a run, and no worries, at least from this recent performance, about rising interest rates or what the office market's going to look like in coming months or even the year ahead. That has not weighed on the recent performance of real estate. By the way, this is also among the highest yielding S&P 500 industry groups or sectors. XLRE has an SEC yield in the vicinity of about 2.75%. So you add that to the current year-to-date performance, it's been a pretty good total return thus far for real estate stocks within the S&P 500. Now our next chart takes a look at social media companies, which are part of XLC. This is the communication services sector. And you'll take a look at this industry group, which continues to perform very well. XLC contains companies that you've never heard of, companies like Alphabet and Facebook and Twitter and Netflix and others. And you can see it's enjoying double-digit returns. XLC was introduced in 2018 after the S&P 500 Indexing Committee decided to reshuffle some of these companies that were previously in the technology and telecom group. They decided to carve them out and form the communication services sector. So this industry group continues to do pretty darn well as we get deeper into 2021. We've also got the other two industry groups in this same chart, technology, XLK, and healthcare, XLV, which have modest gains of about 1%, but are flat compared to other industry groups. And they're also flat relative to the broader S&P 500. Our next chart takes a look at some of the higher inflation or inflationary plays and ways to hedge against that. And some of these areas like commodities, ticker symbol USCI, the Bitcoin Trust, GBTC, as well as the materials sector, XLB, have been real beneficiaries of higher inflation. They've been very strong performers. I mean, take a look at the lights out performance of that Bitcoin Trust, GBTC, over 50%. And of course, commodities, USCI, which contains a basket of different commodities futures contracts. You've got agricultural exposure along with some energy and also precious metals, all inside USCI. And it's delivered some pretty nice returns year to date. And take a look at gold, speaking of precious metals, which has been MIA and has not joined the party. What the heck is going on with gold? Well, so far it's still on snooze patrol for gold. It's still in hibernation. Maybe it'll wake up for the spring and come out for the summer, but as of right now, gold is not participating in the inflation trade. That takes us to our final chart of what we might say star performers. We'll save the best for the last, or the last for the best. And after being hit the hardest by the global pandemic, we've really seen a nice rebound in the energy sector, ticker symbol XLE, which has shot ahead over 41% year to date. That is the top performing S&P 500 sector thus far this year. Energy stocks have been lifted by the steady reopening of business and travel. And as more of the population gets vaccinated, that bodes well for that particular sector. XLF is also doing pretty good. That's financials. It's up almost 18% year to date. So let's take a look then at the big picture. What is the performance of industry sector ETFs telling us right now about the mood of the broader stock market? Well, despite the recent weakness in stock prices that we've had over the past several weeks, the sentiment towards equities and some of these sectors that we've covered still remains very bullish. Market indexes, if we take a look at the big ones like the S&P 500, Nasdaq, as well as the Dow Jones Industrial Average, are still trading near all-time highs. And among the 11 industry groups that make up the S&P 500, you'll notice just 2 out of 9 are negative. And even so, 2 of those losing sectors, that's consumer staples and utilities, they're not down by much. They're down with modest losses. And so again, that's pretty bullish if we just take a look at the overall number of industry sectors that are up. And then, of course, like I said, the ones that are down, it's just modest declines. So the climate overall is very favorable. And I remind you to use this as an opportunity to take advantage of friendly markets to have and install what I call a cushion or a margin of safety within your overall portfolio. It's very important that you do this before the storm of a stock market correction, certainly not after, and ideally not during. And you can get a margin of safety worksheet in my online class titled Build, Grow, and Protect Your Money, a step-by-step guide. I'm going to provide the enrollment link below in the description section, and that will help you to determine how much of your overall portfolio you can earmark for your margin of safety. And I've showed you this particular diagram before. I will continue to show it to you because I think it's a rigorous, robust way to go about building and managing a portfolio of investments with the idea of creating a portfolio that's architecturally sound and that can handle any type of environment. You'll notice that margin of safety is your risk-free capital. That's money that you cannot afford to lose. You set it aside. It's free from volatility. You have capital preservation. And it complements those other 2 buckets. your non-core portfolio, which is tactical, and then you've got your core portfolio, which is your foundation. And so this is what you do in order to bring it all together. But again, take this opportunity to use friendly markets to shore up your portfolio, build on the strengths, eliminate the weaknesses. And those of us that want to get a little bit more personalized, you want a full-blown analysis of your investments, I'll be glad to do that. Just get in touch with me at portfolioreportcard.com. I'll analyze and grade your portfolio. So that does it for this particular episode. I hope you've enjoyed it. Thanks for watching. I'm DeLegge with ETF Guide TV. Be sure to subscribe, and we'll catch you next time.